Live, everybody. Midas Invest Live. Sure, everything looks good. The sound looks good. As far as I can tell. All right. So Monday, everybody. A little bit of a different time to be streaming today. Took the day off. I kind of bunch of vacation days kind of randomly throughout the year. Kind of trying to use some of those for streaming so I can kind of during the market a little bit, which maybe that means potentially there'll be viewers because I just work. Maybe not. Kind of depends on where you are in the world. We'll see. But the point is, have plenty of things to discuss. So it doesn't matter one way or the other. Hope I can chat with them. Lots of talk about a little bit. So get into stuff. See how long the stream goes today. Uh, that kind of depends a little bit. My mic's good. It kind of looks like it's doing good, but it's sort of almost like it's stuttery. But anyway, here's my portfolio. Nothing much has changed. I think talked about it really. Uh, and I've been static for the most part. I bought too much tea more in the last couple of so. Still kind of want to, still find it attractive, but up here, so be a little more selective uh, when if I do purchase them. In fact, I've actually kind of been looking a little bit more at Generac. Here is wider of a gap between my holding size, my uh, target max sizing, and then setting that a little bit more for well. But really, I've just kind of been reviewing all of my positions, kind of rethinking valuation, kind of double checking models a lot. Really, just kind of doing a lot of managing and maintenance on my core portfolio. In fact, really, I haven't looked at new companies much the last couple months, or definitely, which was somewhat of the intention. While I was doing a lot of my FG work, I was kind of focusing on my companies more because I wanted to concentrate in them more, and I still am. Still want to concentrate in them more, but I've definitely done the work that makes me satisfied with knowing where I want concentration. So I am in a position to look a little bit more at new companies. I think more going forward would be good. So one second. YouTube's also kind of giving me a sign about the audio. Try to double check. I want to get far and stream. But I check it. The testing. I don't know. It does kind of sound a little stuttery if I'm listening to the stream myself. I don't know. Maybe I should have the mic a little bit closer. Kind of sounds like maybe the filter settings that I have on the mic is a little sensitive or something today, but I can't really adjust that too much while I'm live. So I'll have to, like I said, just kind of try to speak clearly and into the mic with it a little bit closer to the face. But anyway, so as I was kind of saying, definitely trying to add a little bit to Generac. Potentially, I want to add to Equinox or Hydric and Struggles as other ones that I have a little bit of a gap on. But I am definitely trying to be very selective about that in terms of what days I buy on and don't buy on. And obviously, with the market has kind of back and forth a little bit. We've had a very nice little kind of upward movement right here, so kind of pulled back my buying a little bit because of that for sure. Which there's definitely good reasons for this rally to have occurred, but nonetheless, I do sort of look at it as a rally that's likely to be sold at some point to a certain extent, even if the economic situation kind of takes the more optimistic pathway, in my opinion, which is to say that we don't really have like a serious economic slowdown this year, but nonetheless, we still have a little bit of a slowdown. Obviously, we still had our first negative GDP print this last week. But the point is, it could just remain at one or two negative GDP prints without really like trailing into a significant effect on employment. And if that's the case, well, then, yeah, I mean, there's significant reasons to believe that we're not necessarily going to go significantly lower than we did, but that doesn't necessarily mean that this rally this quickly is still that correct. So, in my opinion, uh, seeing a retracement from this level is pretty rational. We'll see what happens with that. I am, reasonably still well positioned. We're only at 3 to 4% cash overall, so yes, we do have our index position that kind of allows us to be relatively full invested, even if we're not at full allocation for our individual positions. So either way, we're well positioned for the rally to continue. But if the rally was to pull back further, we could potentially sell some of our index position to add more Generac, maybe add a little bit more FG, maybe add some of the other positions depending on what happens and whatnot. So that's kind of the kind of short term plan with those positions that we're not at full size with. And then as I was kind of mentioning, I've done a lot of reviewing of my positions and kind of reviewing what my models assumptions are and how confident I am in those assumptions. And in particular, I've definitely spent a lot of time in the last 2 weeks focusing on my gold mining positions. Obviously, page here where I have well a significant position just in the Granite Shares Gold Trust. So that's not a gold miner, that's just a gold trust, but nonetheless, I kind of count it as like the as part of the aggregated gold position. But I have that as well as I have Silver Corp, EM, New Gold, the Equinox EQX, and Orla Mining ORLA. So you can see pretty significant amount of gold mining. The allocations that goes between all of those together, that is 19.1%. 19.1%. So, if you look at all gold together, that becomes my second largest position, right? Because FG is at 21.4%. But if you add all of those together, you end up with a pretty big position. And you could argue, obviously, the gold trust is a bit different. So take that one out of there and it becomes instead 12.8%. But 12.8% is still a pretty significant position, right? And in a sense, I do think of them kind of as one position in that way because I do select the gold miners in my portfolio here partially based off of the other gold miners I have in my portfolio. Like in some senses, the geographic distribution of the assets between all four of them, as well as the cost distribution of the assets, the quality of the management. Like I think about all of them together because I am essentially trying to balance out my gold positioning overall because of the commodity nature of it. It's a little bit different than other industries in that way, where I think it's actually something to kind of do that. I mean, all of these are relatively smaller companies, so that I can kind of pick and choose those locations of the mines more specifically. So yeah, in a sense, I really do have kind of a 13% gold mine position on an aggregated basis. So pretty big position, and that's a long way to say that I've been kind of doing a lot of focusing on that position lately, because well, I mean, gold's gold's been kind of going bananas lately. And then obviously in its crazy upward movements, had a decent little pullback here recently. Kind of, a relaxation period, we'll call it, because it was pretty significantly overbought for quite some time. I mean, if you go to the monthly chart, I mean, just look at that. It's pretty parabolic. So the idea that it decided to have a little bit of a pullback is pretty reasonable. In fact, if it wasn't for the almost 3% that it's up today, that monthly candle there would be red candle. So it is still slightly positive this particular month, only because of the green candle that we had today. So that could have been the first pullback month potentially. So anyway, the point is, over the last couple of weeks, I've definitely been trying to do some hard thinking about this, hard thinking about just like what level of risk am I taking on with my exposure to gold, because as bullish as I am on gold in the long run, like my bullishness about gold has not really changed. It is definitely one of those things where you do have to try to take into account what happens in the short run. If for no other reason, then it does affect the cash flows of your company. So it's like, what assumptions do you put into your gold miner ETFs? Like, do you just use today's gold price for 10 years? use a 10-year average gold price? Do you do some sort of formula thing to try to figure out what you think gold prices are going to be? There's all sorts of approaches to doing it. And I mean, I have my approach, I have my method. But the point is, I am kind of constantly rethinking and readjusting that approach. So we're definitely going to go into gold a little bit more in depth here, but I do kind of want to cover other stuff a little bit first before we go real deep into that, because that's gonna definitely cover some stuff. Um, so yeah, the point is that's 13% of my portfolio, definitely real, just the mining part, but then 19% if you count the actual gold part, right there. And this is just a gold ETF. It's just gold trust. It's not gold that I personally own. So it is essentially just a financial asset, not something that like this is. Because like a lot of people will be like, oh, I own gold as like as a sort of form of insurance, and it's like this performs financial insurance, but it's still not going to act like the same way that physical gold is. So there's a difference in my opinion. Yes, physical gold in that sense. So point is even though I sort of look at gold as almost like something you want to hold almost permanently, I don't think that's necessarily true for ETF. So that's kind of why I say that. It's like I am way over my position sizing for my gold ETF, as you can see right here. It should be pretty obvious. So the point is do I want to trim that down to size? And I probably do want to trim it down to size. So I will say in the short run that my plan regarding my gold ETF is I am essentially allowing it to run on momentum in the kind of short to midterm uh, future. So my plan is to kind of just let the gold ETF ride, but I am paying close attention to like the moving averages and stuff. I'm going to use some pretty basic, stereotypical kind of momentum approaches to this, where basically if we get like a if it crosses below its 200 moving average and holds there for more than one close or something like that, then we'll potentially sell at that point, which I'm willing to do because I'm up significantly on it. So the point is like that actually creates a buffer where I can probably get out and still have a decent profit on my holdings because of how well I've done on them. So I can kind of take a momentum approach to that particular position, given it is just a commodity. So you kind of have to come up with some sort of position about that. But like I said, we'll talk about gold a little bit more in depth here in a little bit, because I've gone very deep into the fundamentals of gold over the last couple weeks too. But the point is um, you can go into the fundamentals of gold, but that doesn't mean the price is going to behave accordingly with it. So that's why I say is like sort of have to have an approach to that. But I also did the fundamentals of gold because, like I said, I have my miners. I'm definitely willing to trim down significantly on my gold ETF, but that doesn't mean I want to trim down on my miners position. I just might want to be more careful about how much more I add to them, because I could add to some of my miners, although I am overweight on some of them as well. So, I could consider that as well. So the point is, either way, the point is I am trying to definitely think very carefully about what my strategy is for all of that those positions and all the details related to that. I spent a couple months thinking about FG in depth, and I've basically made all my kind of plans and decisions around that. Doing the same thing for the gold mining positions. But I have basically done the same thing for Generac too. I didn't really make a stream going in depth into my adjustments to uh my model for Generac, but I did. I have gone through and redone my model for Generac as well, and that's part of what made me bullish a lot more again on them. I definitely do think that they have pretty significant growth opportunities going forward, and it might take a year or two for that growth really to start to take off because of the kind of economic environment we're in. They are a very discretionary type product type thing type situation, and they can definitely probably be impacted by the tariffs as well, given the input prices on their products, and hopefully depending on what types of products those input prices are, maybe that has a big effect on their ability actually to source certain inputs. Maybe not. It kind of remains to be seen. Um, they did have their earnings recently, Generac, which kind of is the next subject I did want to get into, is the earnings that have come out for my portfolio so far. Oh look, the next round of earnings actually just popped. There was earnings that was expected here today, and I hadn't come over to this page an hour or two. So Hydric and Struggle looks like they just reported. But anyway, wow, that gives me one more to talk about. Here's my portfolio, and I really like this website, by the way, stockanalysis.com. I like them for a lot of things. It's definitely on the rotation of sites that I like to use for looking at one piece of data or another. I kind of originally liked going to this place because it had really a useful dividend data, but I have started to really like a lot of it. website has. I've actually been considering recently potentially switching over my subscription to Ticker to stock analysis. It's kind of hard to know if I want to do that because like Ticker um isn't amazing at some things, but it does do certain things really uniquely that other data kind of source sites that exist, don't do, and specifically in a way that's useful for my evaluation process. Like I want to have a website that makes it very easy for me to copy paste or import all of the financials of the company in a really clean way. Um, that it's not just imported cleanly, but also in a way that I can manipulate in my spreadsheets effectively. So it kind of comes down to like how they themselves word a lot of the things in the financials. So that's why it's really particular. Like it's kind of hard to describe why I prefer Ticker, because it's like super nitty gritty and like how spreadsheets work is comes down to like the reason why. But I've been looking a lot at this website right here, so I think potentially I might actually switch over to this. It might be able to suit my needs, and I do think it's pretty good at a lot of other things. Well, I do think Ticker still has potentially a better screener, but there's a decent amount of their screener that you can use for free. So that's why I'm kind of still considering it. But anyway, random tangent there, but something I've been kind of considering over the last couple months. I've been kind of slowly using this website more and more. Like I do like to use it as a place to monitor my portfolio in particular, like for earnings. Like so you can see right here, this is the earnings sheet here. I really like the way that they have these right here, and you can create like multiple little watch lists stuff as well. But you're limited how many watch lists you can do unless you have their paid subscription thing. So that would be one feature that I would be able to unlock as well if I had a subscription. But I do like the way that it lays out the information here. There's lots of websites that do this kind of, same stuff, but the layout is a particular detail here. But anyway, the point is in mode, New Gold, PayPal, Generac, and now Hydric and Struggles have all reported in my portfolio. So I'm kind of looking at them. I kind of wanted to talk a little bit about all of them, I guess, or some of them more than others. InMode reported they hit their revenue estimates, didn't hit their EPS estimates. And then there was a pretty big drop in the stock, um, which was partially on the backs of comments from management. All obviously they still didn't meet the yes number, but I do really think it was much more about the comments from management, because it kind of continues the drama about capital allocation with this company. They did do another pretty big buyback in the month of April, which is pretty interesting because that means that it's not in the numbers. It's not it doesn't show up in this EPS number right here. So technically, like if you even just adjusted this EPS for the buyback that occurred in April, then the EPS would be higher. Well, this is the estimate. This is the I didn't do the math on how much higher it would be. It's probably like 32 cents, 33 cents or something. It's not going to be a crazy amount higher. But the point is they do another significant buyback during April, which is technically quarter two, so it's in this next quarter. But the comments that they made was kind of imply that they don't want to do any more buyback. I would say that the comments were actually a little bit mixed because technically the CFO made comments. It was kind of a generic statement where he basically said, "Oh, we have this is our cash balance, and we're looking our priorities, and this is our priorities." And then he listed it, which was organic growth, acquisitions that are accretive to EPS growth, and buybacks. And he said it in that order, and he said it. But the point is like I said, it was kind of a generic statement. But the point is they planned that statement out. So the point is that if they thought buybacks was a complete no go, I think they would have edited that statement. It's like they did plan these statements out. But then the CEO himself, in the comments, was asked about capital allocation, and he mentioned the drop in the stock price that we've seen uh, since they've done the buyback. Which I mean, over the last year or so, or really it's like last year and a half, he was talking about. So I mean, basically he was complaining about the fact that the buyback had no effect on the stock, so to speak, as he said it. And I mean, again, this gets back to kind of the same drama that we had when he made similar comments in the past about why he didn't want to do it. He gave examples of some of his competitors or other companies that had done buybacks, and the drop in stock that they have. He seems to be kind of have the perspective where he thinks the buyback is supposed to support the stock price in the short run, which admittedly he's not the only person that thinks that way. I see a lot of people in the retail investing community that have this kind of attitude where they think of buyback as the thing that is just going to support the stock price, like the management is going to be able to hold the stock up during a bad day or something like that. It's like, I mean, in a technical sense, that sometimes is true, but it's not really true to any sort of substantial way. So that's kind of why I say it's like, I think it's kind of silly to think that way. It's like that might be true on an individual day, but that's not really going to be true over like a whole quarter or a whole year, particularly. And I don't think that they're doing it particularly strategically like that. Like they're looking at the market and then they see the stock price down and they're like, okay, time to support the stock price. I mean, they do have a plan to buy the stock. And ideally, they want to get lower prices, but they do assign finance people to do that in trade in that kind of sense, or they have some sort of financial institution do it for them a lot of time. That's the case. Well, so they are trying to get low prices in that sense, but it's just because they're buying it. It's not they're not thinking about, oh, we need to support the stock price. It's like, nope, they're just buying shares. So I mean, the point is like he's got the wrong conceptual framework for what a buyback is, and everyone in everyone seems to understand that, and so obviously we got a big sell off on the stock price. But the sell off, I think, is also because he seemed to imply that he didn't want to do any more buyback going forward, even though they do have a significant amount of cash, which their cash levels are now back down to where they were. I think about 3 years ago, it was like somewhere in 2022 was where I saw that cash level again. So they have brought their cash levels back down pretty significantly, but they still have a ton of cash because frankly they just have a ton. So it's like they had already moved up in cash pretty significantly even while they were doing the buyback, and then now they kind of brought it back down. So they brought it back down to a high level, no longer a super high level, and that's relative to their balance sheet. Relative to the market cap, it is a super high level, but that's because the stock price has come down. So we'll see what happens with the company. I'm happy to see that they're at least hitting the revenue estimates. It was a weak revenue estimate compared to the previous quarter, so it's like they hit the estimate, but it was a weak quarter nonetheless. It was expected to be a weak quarter. Hopefully, we do start to see that turnaround in the cycle for new machines by the end of the year. Obviously, the economic situation, kind of similar to Generac, as I said before, it's like the tariff economic situation could potentially push that window outward, because we're talking about two different companies that kind of play into that discretionary purchase angle differently, but they are both very discretionary companies. So yeah, well, it's going to probably be a continually not great year in mode. It's probably going to be waiting for 2026 for them in terms of like, again, getting back to the machine cycle. So we'll see what happens with that on the fundamental basis. As far as management, I know everyone basically just hates the CEO because he doesn't seem to understand how finance works. And it's like, as I said previously, I had kind of defended it on the basis of saying that I would actually prefer somebody who is more an expert in the product than somebody who's an expert in finance. Because in my opinion, the CFO can continue to kind of prod him and be like, hey man, this is how it really works. And the analysts do the same thing. Because my opinion is last year he essentially did get bullied by the analyst community into doing some buyback. So I'm kind of hoping that maybe we just get that again. It's like, yeah, he doesn't want to continue doing. He's the share price going down, but you know, once the share price starts to move upward again, and then we start to get credit for that huge decline in share price significantly, I feel like he'll realize why this was the move. It's like it's not about supporting the share price; it's about compounding the EPS growth long term. That's what it's about. But yeah, okay, he's not a finance guy, so that is what it is. Hey Scott, three insiders hold more than Doma. He's talking about Mastercraft, that right there. Yeah, we've gotten some more insider activity on Mastercraft, which they report in 2 days. So it'll be interesting to see on that front. Another discretionary company, yet again, very different than even Generac and InMode, but all three of them very discretionary type products. Different kind of forms of discretionary, but still companies that are probably not likely to have amazing 2025s, one way or the other. All three of them could have good 2025s depending on what happens. But the point is my sort of base case is just like, yeah, wait for 26 for kind of all three of them a little bit. But yeah, nonetheless, insiders seem to be all over Mastercraft. So I don't know. Maybe the upper income groups um uh spending patterns will be able to kind of buoy the Mastercraft story nonetheless, even though it is kind of an ugly tariff economic picture. We'll see. We'll see. Maybe it'll be better than expected because yeah, those funds are kind of hopping all over it a little bit. I myself have been kind of capped out on both in mode and Mastercraft. I already kind of talked about my positioning for Generac, so I am obviously still trying to kind of hopefully add more to them. But for in mode and Mastercraft, I've kind of been basically capped out on my allocation for them. It's kind of come down a little bit on in mode recently. The allocations moved up a little bit because I think because the share price moved down. So it's like these there used to be no gap there, so there's a little bit of gap there now. So maybe I could add some a little bit at some point in the near future. But both of them I've kind of been capped up on. Um, Frankly, I kind of just wish I'd been a little bit slower into adding both of them, obviously. But in mode, that's obviously old news. Mastercraft. But yeah, we'll see what happens with that. Yeah, PayPal, as mentioned, PayPal back down to 70 again. I definitely was spending a little time looking at PayPal as well, which that's one of the next companies we were going to discuss here on the earnings list. PayPal um, didn't hit their revenue estimate, but they did hit their EPS estimate, so good on that front. And they pretty sure they reiterated their 25 guidance as far as transaction dollars. I think they might have moderated the margins element of it. If I remember, I can't remember 100% off the top of my head. But the point is, nonetheless, I felt pretty. I'm feeling pretty good about PayPal. It's like they also, all these companies could have stress 2025 for one reason or another, basically. But it's like one of those things where it's like we'll see what happens with PayPal, but they've still performed really well over the last few years, kind of quietly. And I should say really well is kind of a strong word. They performed well. They haven't had like crazy, massive growth or nothing, but they've kind of just chugged along ever since Chris kind of came into the picture. Not such strong growth to like really make massive headlines, but they've still kind of like kept pace with. They've really kind of like consolidated and continued to pull up their monthly active users on on a quarter after quarter basis. So it's one of those things where it's like, I still sort of expect PayPal to continue to have a good year, and they do have their explicit buyback program still locked in and in place. So I am still kind of hoping that that also will continue to kind of compound the current picture with them. And then PayPal has come down, and well, they've kind of moved all over the place a little bit. So my current valuation for them is at 80. So not the highest, but I would say this is being um, it is based off my model, but I would say my model is being somewhat conservative in terms of the growth for them. The thing about PayPal is like their space, the space that they're operating in is like a no brainer gonna grow space. The question about PayPal is like just how well they're gonna compete within that space. It's like it is a very competitive space. So, like that's really the thing for PayPal. It's like with a lot of because I can compare it to like a lot of my other larger positions are based around kind of like my thematic stories around the industries. But for PayPal, it's like I've actually done much less kind of like specific research on the industry because I almost feel like I don't need to for PayPal. It's like e-commerce payment rail space. It's like, yeah, that's like a no-brainer gonna grow space. But the question's more about the company quality, the brand and consumer appeal, and details of that nature, and how profitable it is for them. So obviously, ever since the new management has come in, they've been focused a lot more on profitability. I think they've done a really good job on that front. It is a very competitive space, and so in some ways, like their kind of the top line profitability, the kind of gross margins end of it, I sort of like in the long run always kind of expect those to continue to deteriorate a little bit. But I'm hoping that they can kind of continue to manage those mid-level expenses, the kind of more operating expense level, to continue to eke out strong profitability growth. And then there's the buyback on top of that to kind of create the EPS growth more solidly. But I will say when it comes to PayPal, it's like I do go back and forth in terms of like what is my strategy for holding them. Because like I said, it's like the space is growing so much. So it's like it fits into my desire to be in an industry where there's a lot of growth potential and for the long run. So part of me wants to hold PayPal for the long run for that reason. But another part of me really doesn't like how competitive the space is in a way where it's like, in my opinion, it is hard to really eke out a competitive advantage and make it last forever. Um, Obviously, if you're the top duopoly like Visa and Mastercard, it's a little bit easier for you. PayPal's done good as a niche, but it is one of those things where, potentially speaking, if we get a much stronger pop where does go significantly above my fair value, like if we got up to like 90 to $100 per share, I would probably want to get out of there. Obviously, that's a long way from where we are now. But the point is like, I think maybe I would want to be a little bit more nimble in terms of my holding for PayPal, or at least desizing. Maybe not necessarily getting out entirely, but desizing. So that's kind of thinking towards the future. Obviously, something to think about when it's it's down here, and not up here at close to 90 where it was. Here's looking at you, Scott, who absolutely timed that, like unlike me. But that's fine. That's fine. Yeah. Like I said, and that's where we currently are. The valuation technically grows over time too. So if it takes a year or two to kind of get back up there, my feeling might be more around the $120 range at that point. Who knows? Um, Going on from there, then we did have a new gold report as well, which I don't necessarily want to get too into the weeds on that one. It's a kind of a complicated one. They did significantly beat their revenue estimate, and then kind of met their EPS estimate, that being the gold miners. So really, EPS isn't really the thing you want to focus on. Really comes down to more about the cash flow questions. And I was pretty pleased with a lot of the production figures that came in with that. That's kind of gets into a little bit of the nitty gritty of it. I was actually kind of focused more on the gold mining space as a whole, looking at some of the other gold miners that report as well. Like, but Newmont, which is one of the larger gold miners, and Agnico Eagle as well. One thing that's kind of common with them is that a lot of them are actually beating their revenue estimates pretty significantly. I think that's because, frankly, Wall Street is underestimating just how much the gold prices are getting realized into their revenues in the short run. Admittedly, a lot of gold miners do have hedging to various degrees, or use future contracts to certain degrees. So how much of it shows up at what time frame can be a little bit of a tricky thing to predict. Gold prices are going up as fast as they have been today. So the point is yeah, kind of expected this for gold miners to significantly outpace expectations for Q1, and I sort of expect that to be true for Q2 as well, based off of where uh, estimates currently are. I mean, estimates could be revised up a little bit, so that could change before we really get there. But yeah, very very exciting. It gets to my earlier comments about gold, which, like I said, once we get through kind of these earnings bits, I'll kind of get into more detailed about my thoughts about gold in terms of the fundamentals and the pricings of that. But yeah, very interesting. But then yeah, as I just brought up, HSII is another one on the list. Well, I didn't really say anything about Generac. Generac also beat revenue estimates and it actually beat their EPS estimates much more strongly. I was very happy with those numbers. Actually, particularly happy with the residential numbers too, not relative to the CNI numbers. Their guidance is that they're expecting CNI to be flat this year and residential to basically be where the growth is. And even residential, they're not expecting super strong growth this year. They're just expecting that to at least be positive on the growth end. But this first quarter looked a little bit more optimistic on that than their guidance gave. So either the back half of the year is going to be weaker, or potentially their guide is undershooting it for the year. So very good to see on that front. And then we're really only getting into the season where we start to see a lot stormier of activity. So that's always the fun kind of catalyst for Generac, is watching the storm reaction. But like I said, not I'm totally willing to just wait to see what happens in 26 and 27. I honestly am just pretty bullish, I think, about the growth potential for Generac in the future. It's like there's uh there's certain things that can kind of break down that story, but really they're kind of things that require a significant amount of development. We'll kind of see them as they're coming. Frankly, it's like if the thing that would break up the Generac story for me is whether or not a competitor substitute product comes into the space that would like significantly change the economics for a gas powered home standby generator. Like specifically, if they got like electric generators, they could somehow do it differently. But the question is like, well, I mean, how are they supplying the power? It's like you'd have to have like crazy battery technology or something. Like, it's like I try to think about like what would be the substitutes for this. It's like there's a reason why these products are ideal choices, because if your power grid's out, your power grid's out, right? Like that's the thing. Like this is the backup to electrical, is using these gas standby generators. So yeah. Natural gas. I mean, natural gas is. I mean, technically you can use liquid gas or natural gas for these types of generators. It kind of comes for the types of hookups for them. So that is a little bit of a substitute for it. But I kind of look at natural gas prices as somewhat playing into the story a little bit because North America has such low natural gas prices relative to the rest of the world that it somewhat drags down gasoline prices relative to the rest of the world too. And so it's like, in my opinion, that's actually one of the things that makes Generac products more appealing potentially. It's just because of the dynamic of natural gas and the effect it has on the kind of the broader gas and carbon product markets. So kind of, but technically speaking, yeah, a new technology could come out to more directly use natural gas that could be a substitute for that. But point is, unless we have a huge substitute for this type of product that can come out, logically speaking, the Generac story, in my opinion, is just a very strong one. Um, Application moving to natural gas, stove, dryer, etc. Yeah, no, I mean, because yeah, obviously certain things have, but it comes down to the hookup. Um, there, like I said, there is some movements in that regard. I definitely am like watching those things, but I mean, nonetheless, they still have a huge amount of dominance in the space, and the penetration in the space is still growing year over year. So anyway, HSAI. I do want to look at that. That's breaking news. Right off the bat, solid beat on revenue, and they missed their earnings a little bit on the front. I mean, it has it here too, but I wanted to know whether or not it was a fraction on the EPS there. Um, Interesting. Pull the piece up. Okay. Margin, adjusted EBITDA margin 10.3%. Pretty solid. I wish I said what the new quarter last year was. I don't remember off the top of my head, but I think it was more like 9%. If I was to guess off the top of my head. First quarter results exceeds the high end of our outlook, a testament to our resilient business model, our team's focus, yada, 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 yada. Oh, 9.8% here, 0.3%. So a little bit of growth in the margin. Where it's not a super high margin company and not a lot of changeover in that. They have high aspirations for growing their margins. But if you go back and watch the video I made on them, I did in many ways sort of poo-poo a lot of their aspirations for certain changeovers in their distribution of the segment revenues as well as how that was going to change their margins. I basically said I was like, well, it'd be nice if it happened, but my assumptions aren't going to rely on that. So it's one of those things where it's like I'm kind of just assume their margins are going to kind of stay in the same range, which I don't remember off the top of my head where my valuation had for that either. Let me pull that up real quick. What was kind of my average applied EBITDA margin for, yeah, so for the average for the 10-year forward EBITDA margin I had was 8.8% for my DCF assumption. So yeah, that means 10.3 is solidly going above our expectations on that front. So I'd kind of higher margins in the first few years, and then I kind of have it trail off a little bit in the few years after that. But nonetheless, we're going above our expectations. That's what we like to see. Um, Oh yeah, and Scott's comments there. Give me them 25, 28s. Not a business I'm super excited about. No, yeah, definitely. I mean, that's the approach you kind of have to have about it. It's like on one hand, like I'm very happy to see them do well. And you can see like in my positioning, like I have room to add to them as well. But it is a zigzagger. I do think you kind of have to look at it that way. I think you really do have to kind of look at it in the long run and kind of assume that it's going to do a whole lot of this kind of action. And then you really do just want to pick it up on those bad downswings. And it's partially because of those low margins. Or like I said, they're not even like super low margins, but they're definitely not high margins. So it's like they're kind of just typical margins. So that means it's like whenever the market gets convinced that they're going to be like 5% margins forever, then they swing down real badly. Then there's going to be a point in time where the market gets convinced that they're 15% margins or something, then they swing up a little bit. So it's like, yeah, you do kind of want to get that zigzag. And so it's like, yeah, we're at the kind of the top of the zigzag right now. I can understand the kind of want to being like, this just doesn't seem like the right time to grab them. Because as I've kind of reiterated to you as well as other people many times before, it's like this isn't like a huge growth story. It's just revenues that aren't going anywhere. That's the thing. It's like this is a stalwart company. Like I feel real solid that this bad boy is gonna be here 10 years from now, or somebody will have acquired them. You know, it's like the only reason I think that they wouldn't be here 10 years from now is that somebody just snapped them up. So like that's the only question on that front. They're not a huge revenue growth story by any means whatsoever. They're really just kind of like a nice steady eddy, easy cash flow um, machine. And cash flow machine, they don't necessarily have like crazy high cash flows, but the point is like the profitability is pretty expectable, pretty consistent. And I kind of said that in my story about them too. It's all surrounding about the generational story with the CEOs. And I do think that they have kind of a good tailwind from kind of the higher levels of boomers in the CEO numbers. But nonetheless, it's like even over kind of the long run of the cycle, there's only so many CEOs a year that turn over. So it's like that just is what it is. But I kind of put them in the same camp as Smith and Wesson, actually, where it's like both of them, like those revenues aren't going anywhere, but they're also not really growing either. So it's like you kind of want to grab those companies at the nice low price, and then kind of trade off of the range. But nonetheless, it's like that range should move upward over time. So just because we're at kind of an upper end of the cycle, it doesn't mean we're going to come all the way back down to here. It's like you said, like 25 to 30. That might be a good spot to consider. Because yeah, I mean the profitability they should still grow over time. So it's like there should still be a bottoming out somewhere. But um and obviously there's the negativity surrounding consultancy firms right now in general. That the negativity about Doge really doesn't apply to them because of their business model, but it is hitting a lot of other companies. So eventually that might start to slide as well. Um, those last few comments you made, recession or job cut times kill the stock. Yeah, I definitely think potentially so. But it is one of those things where yeah, I mean obviously yeah, you look at their stock back from 2000, or 2000s, they had an even crazier time than 2008. But yeah, 2008 was also pretty crazy for them too. But yeah, no, I imagine they were a little bit of a different version of themselves too. So that's the other thing you have to take into account, is that like all the analysis I've done on the companies like the last 10 to 15 years, haven't really focused too much on necessarily like how they were being managed back here. So it's like it's potentially possible that some of this decline came down to like them being poorly managed on the come up a little bit. Maybe, but it could also be entirely that they did just get massively, the business was thrown into the garbage shooter because of the recession. I don't know. It's hard to say. They also could have been doing other types of consultancy at that part. That's why I say it's like it could have been a little bit of a different firm at that point. Like maybe they did less executive search and they did more base consultancy, which is like executive search. Like it doesn't matter if you're in a recession, CEOs are still going to turn over. Maybe if you're in a recession, you're going to spend less money on the executive search firms, but you're still going to have to replace your CEO nonetheless. In fact, I would argue during a recession, you're probably going to have more CEOs to replace, actually, you know? But nonetheless, like I said, they could have been levering up during this period right here. And it could have been the leverage that really crushed them here. Like I said, total speculation. I have really no idea what happened way back here. I've only really looked at like here onward, really. Um, but yeah, but nonetheless, yeah, I put him in the same camp as kind of like Smith and Wesson, where you want to play the cyclical move of the stock a bit. It's a bit of a channeler, um, even though yes, I do think the revenues and the story behind the revenues is at least solid. It's at least something you can count on for the next decade, but it's not necessarily something that's going to grow a whole lot. Those last few companies made, their companies rather use AI than price for their special exec searches. Maybe. I mean, we'll see how good the AI selections for the CEOs turn out to be, right? But that could be certainly a fad that Detroit CEO does buy, and that's worth watching. Yeah, yeah. There's that at least. There is that at least. Let's see. I can't remember if there was any comments here. Maybe I wanted to get average revenue per executive search moved up a little bit, but only barely. Consultancy productivity moved up a little bit. any number of consultants moved up a little bit. So that means like the productivity moved up even though they increased their consultant count, because that's kind of like what that is a divided number there. So if both those move up together, that's good. And then this moving up is good. Revenue before reimbursements. And for second quarter outlook, I kind of already read this. They're expecting around 300 million, which is kind of in the same range. It's a little bit higher than this quarter here. I can't really remember off the top of my head uh what their like peak quarter looks like. The AI is the CEO. When you have a CEO search firm, and then the CEO of that firm is AI themselves. Okay, so they're saying that they're expecting close to peak revenues, potentially peak revenues next quarter. Or wait a minute. Oh, well, maybe about the same revenues as they had in their peak quarter in 2022, but close to peak revenues, but not like not crazy record revenues. But they're basically expecting revenues somewhere between around here and around here. That was their range they gave. So in the ballpark of peak revenues they're they're guiding for next quarter. That's interesting. That's kind of interesting. That is a little bit of a bump up. And I mean, let me see. That's gonna be their second quarter. So I mean, let me see. Seem like that was a second quarter, incidentally. That highest revenue quarter was actually a second quarter. I don't know if that's a coincidence. Maybe they often have higher second quarters. So I can't remember they meant what they mentioned about the cyclicality that, but interesting. Okay, so yeah, we'll keep an eye on them on that front. See, how's the market doing on that? I mean, down for the day. No real post market movements. Yeah, so I don't know. Maybe we will add a little bit to them. Maybe we won't. We'll see. As I kind of said, it's one of those ones you kind of want to be careful of. But we do have a wider margin for them than we do for some other ones. Kind of a percentage basis, like Generac, HSII. So we'll see. Maybe we'll consider adding some there. Like if we get kind of a good look in the charts or a good technical look to it and make it feel like we want to buy. So anyway, let's move on from that. So that's kind of our discussion of earnings. That's kind of where we are on that. We'll see what happens with some of the next few earnings here. We get several of them on the 7th, including FG and FNF. That's them. Also Mastercraft, Skyworks, and Equinox. And then 2 days after that, I'll get Orla Mining as well. So basically, this week is a pretty significant percentage of my portfolio that reports, and the exciting ones on FG's front. I did. I don't really want to go looking for them right now, but I was looking at the Limra website where they report a lot of the insurance and annuity data, and I was looking at the Q1 preliminary data for annuities, and it did look kind of like not a super strong quarter. Particularly, it was kind of strong for the index universal life segment, but it wasn't really strong for annuities overall, and it wasn't particularly strong for fixed index annuities either. So we'll see what happens with FG. Maybe they do well on kind of like a share grabbing kind of basis, maybe. And then somewhat hopeful about pension risk transfers. I did go looking at that data as well, and that did have a good quarter, relatively. It had a peak quarter, not counting the same quarter of last year, or I had a peak quarter comparing the same quarter for similar years previously, but not counting last year where there was a particularly big deal. So it's like if you looked at all the quarters but discounted last year's because there was like a really big deal in that quarter last year, then this quarter was the highest compared to all the other ones. So it was a nice upward trend if you just ignored the one year, basically was what it looked like. So like somewhat optimistic about pension risk transfer as an industry, but annuities seemed like it was a little bit slow as an industry. That's just talking Q1 results overall. But we'll see how it plays out for FG in particular. like I said, in a few days. So you know, kind of still pretty hopeful on that basis. Obviously, I've added a lot to them in the last 3 months. So yeah, it would be pretty cool. And you know, the CEO himself also added in the last 3 months. So it would be kind of neat if we got some good results and a nice pop on that one on the day. That would be probably pretty excellent for my portfolio if that did occur. But hey, if not, you know, we're patient, patient. Uh, we're not making predictions on that front. So we'll move on from earnings, discuss other things. Uh, some econ data. Briefly kind of bring up a little bit of econ data. I'm not going into depth of that, but it is the start of a new month, so I did kind of update all of my econ indicators data that I like to look at a lot of. Here's my business cycle signal, which I showed you guys. I think the last one I showed you was like 2 months back, relatively on this data here. So we kind of seen it somewhat similar to this. We were kind of just barely nubbing over the kind of like negative territory space. It's nothing too major to say about this. You're not really in a recessionary territory until you're kind of solidly kind of down here, really. So we're not really in the area where it seems to imply recession, just definitely in weakness kind of territory. But watching it month by month and watching the pieces in this as they kind of evolve. Obviously, we had our GDP figure come in, so that's one factor that's kind of going negatively here. But if you go in depth into the GDP figures, it is pretty clear that a huge part of that is the imports, and so that is a lot of front running of the tariffs. We'll probably have not as big of a negative impact from imports next quarter, which means it could be a bit of a bounce back on that front. So we'll see how that plays into. But admittedly, there wasn't that much of the post Liberation Day kind of economic activity in this quarter's GDP. More of that will show up in next quarter's GDP, which will be more of like the reaction to that and how that may or may not have slowed down economic activity. So that's kind of why I say is like the import factor will be a kind of like a tailwind, or really it's kind of getting rid of that basing effect by next quarter. But we might see a larger slowdown in investment activity in the next quarter. That's the thing that I really want to watch. But beyond that, really, I mean, the thing I'm definitely really focused on is employment. Employment. Really, I do think employment data is the thing that you just probably want to watch like a hawk, because that's really going to be the thing that decides whether or not we're just having kind of a technical recession, as they call it, or just kind of like a slowdown in GDP, having one or two, maybe even 3 quarters of negative GDP, which is not great, but it's not the end of the world. The real thing that matters is whether or not we get a significant amount of layoffs. So I mean, looking at unemployment across the various industries so far, we haven't really seen any movement on the overall headline number, or even really any movement within sub industries in particular. Everything's kind of moving still within its usual cyclical patterns on that basis. And this most recent data is as of April, so it's pretty lively data. So everything still looks good on that front right for now. But we'll see how that moves. That's the unemployment data, which is a little bit of a lagging figure. There is also the initial claims and continuing claims, which comes in on a weekly basis, so you get this much more regularly and much more lively. Which I like to adjust it for population, which technically means you can't get it on the weekly level. You can only get it on a monthly level. But nonetheless, for April, still not really seeing movement in initial claims and continuing claims, as far as like as a share of the population. Continuing claims is starting to move up like a little bit relative to where it was over the last couple of years. That's the thing, is like you can see like there has been an upward trend in continuing claims as a share of population over the last few years. But that upward trend happened in 2022 and 2023, and then it leveled off in 24, and we're still kind of leveled off. It's still sort of moving up, but it's moving up very, very slowly. And then on an absolute level, it's actually still very, very low. So one of those things where it's like I'm watching this, and it's like until this starts to move up, I'm not going to be super worried. And then once this starts to move up, then the question is, has this started to move up? And then when this has started to move up, the question is, has these started to move up, which is really the actual employment. Um, and then that itself plays into, like I showed you guys several weeks ago, how you can kind of construct monthly uh, monthly indicators that track GDP based off of other data series. So I did that with the employment data, and here's the employment data for that, which shows us that we are pretty weak, but where we haven't really like super dropped into massive recessionary levels, and that weakness has existed for years at this point. Frankly, we've been economically weak for a long time, and haven't really been dragged into unemployment. So that isn't really about Liberation Day and about the tariffs. Like really, we haven't seen really any impact of the tariffs yet. Any negativity you point to in the economy is either negativity that's not really there, or it's negativity that's been there for a while already. It's like that doesn't mean it's not bad. Doesn't mean it's not something to be concerned of. The point is like you do kind of have to take it in with that. It remains to be seen how the tariffs really will affect things. Those other series have personal consumption expenditures for reconstructing of the data, uh, real GDP and reconstruction of the data, the individual monthly series of vehicle sales, goods sales, um, on monthly data, which is actually relatively strong. The manufacturing basis, which has been weak, but has been weak for a while, and productivity, which has actually somehow gotten better in the last few months as well. So it's like, yeah, none of these data series is falling off a cliff yet, but I watch them every month. So we'll know, and I'll be pointing it out to you guys as it comes, if and when it comes. So yeah, just quick little spiel on the economic data. Like I said, I didn't want to spend too much longer on this, but looking at it month by month. So we'll see what happens with it. Especially like I said, watching those weekly employment series in particular. Those are really the things to watch. A lot of for sure. So now, okay, we're about an hour in. We made pretty good time on a lot of the stuff I wanted to talk to up to this point. Kind of had a lot of stuff I wanted to talk about today. But I sort of wanted to get through it quickly. But I want to talk a lot about gold. I did sort of already talk about a little bit about gold, but I kind of want to give more elaborate on my thoughts of gold. I've done a lot of research the last 2 weeks, um, which you'll see here shortly. Doing stuff that I've never really seen anybody do. A lot of this stuff, but I've really been trying to wrap my brain about where I think gold could go, should be, ought to be. All those sorts of things. Is like, how do you value gold? It's not a cash flow, so you don't value it. But how do we price gold? I've thought about this many times, and I've heard lots of people make this discussions about how to think about it. And then, like I said, talking about the supply and demand factors of gold. So we'll go into a lot of that details here. Firstly, let's pull up. I've showed you guys the Gold Hub website many times before. If you are interested in gold and studying it as kind of like an asset class, I always recommend people. This is the website you want to go to, gold.org, the Gold Hub. You can make an account here for free, which is pretty awesome considering how much data that they are willing to give you in depth about the gold markets for free. So that's pretty cool. So I would recommend getting an account there if you want to download it. There's a lot of the data you can look at without even making an account too. But if you want to download a lot of that requires an account. So that's why I say that. But I've showed you a lot of these things before, like the kind of supply and demand stuff. Showed you guys before and gone into them in depth, where they break apart like the supply and demand by category, showing you like what amount of annual demand comes from jewelry fabrication, technology, investment, central banks, like that. That's the demand side. Then simultaneously they do the same thing with supply, where they're like, okay, how much of the supply on an annual basis comes from mine production, producer hedging, and recycling of gold, and comparing those factors over time. I know I've done like in-depth kind of discussions of these things on stream before. I'm not really here to do that today. I'm just kind of showing you where the data comes from. But they also have stuff where they show you the mine production by country, above ground stocks, like how much is estimated to exist in total gold, ETF flows, production costs, future positioning, all sorts of stuff exists on this website. But anyway, I've kind of gone through a lot of this data, and I've had to source from many other websites as well over the last few weeks. Because what I wanted to do is I wanted to try to build some consistent series of pricing measures for gold. And by pricing measures, I mean like multiple, like ratios, um, similar to what we do with stocks. Because like I said, we don't have cash flows for gold, so you can't value it in like a DCF sense. But you can give a pricing multiple on it like you would any other asset. And I've heard people compare gold to other assets in some ways before, but they usually do it in a way that doesn't really make any sense if you actually think about it for a second. So like for example, one thing I've heard people do, and I've even done it myself, is compare gold to the S&P 500. Go to S&P 500, compare it to gold, and you can do that over the long run. I've literally done exactly. I've probably done this on stream several times before and shown performance of gold over the long run, and you can show like the S&P massively outperforms it on some basis depending on where your starting point is. But if you choose other starting points, it shows that they kind of like are in line with each other, which in my opinion, for gold in general, you pretty much always want to show from 1971 or 1972 onward, because that's when we broke our link with gold as a currency. So that basically that's the entire kind of market period for a price of gold is from the end of 1971 to the present. So in my opinion, that's kind of always the period you want to compare with a little bit. But nonetheless, the point is like you can compare the gold price to the S&P 500. You compare gold to silver. A lot of people like to show the gold to silver ratio or the silver to gold ratio. Usually, people are using that ratio when they're trying to actually talk to you more about the price of silver, because usually they'll use that as a way of saying, see, silver is very, very cheap because look at the gold to silver ratio. It's so high, or the silver gold ratio is so low, which means therefore silver should start to catch up at some point. In my opinion, there's a lot of problems with that way of thinking. It's like that's like the same thing as comparing a single share price of Google to a single share price of Tesla. It's like they don't have any relation to each other just because they're a share price. It's like you only do a per share price because you want to compare the profitability across equal units of the same thing. It's the same thing with gold. Like you do the price per ounce of gold so you can compare that price to a similar ounce anywhere else. But you don't use it to compare to an ounce of silver or an ounce of copper or what have you. That doesn't really necessarily make any sense because they have different supplies, right? Like same thing is like I said, like the share price of Tesla to the share price of Google. Like what you would maybe compare between the two is the market cap of Google to the market cap of Tesla, right? Because that's the entire total thing. So that's one thing I've done over the last 2 weeks. I tried to uh, construct the market cap of gold and a time series of it, because I've heard market caps of gold quoted many times on the internet. People, that's why I brought up this above ground stock concept, because there is the idea of there is an approximate record of how much jewelry in gold, how much bar coins there is, how much gold's owned by central banks. There is an approximate estimate of how much gold there is on planet Earth that has been mined, and then there's estimates of how much hasn't been mined as well. So people, and it's not a precise number, but it's probably within a couple percentage points. It's actually probably a reasonable estimate. There is some amount of gold that's been lost, but not much of it. Gold basically lasts forever. So unless it's dropped to the bottom of the ocean, we basically have it still. That's just kind of how gold works for the most part. So the point is like a lot of people will quote a market cap of gold, and it's going to be based on some sort of estimate of the above ground stock times the current gold price. That's how people come up with that market cap. But one thing I'd never seen before was I had never seen that a time series of the market cap of gold. I had just heard people quote it. Like when I first started studying gold, I'd heard people say, "Oh, the market cap of gold is like $10 trillion or something like that." And then at some point I heard people say, "Oh, the market cap of gold is like 15 trillion. Oh, it's 20 trillion." It is in fact currently like 22, 23 trillion by the way right now. That is the market cap of gold. And so like, you can think of it like compare that as an asset class. 23 trillion for gold. I think US equities are like 50 to 60 trillion. So you can see like the entire global market cap of gold is about like one third or to one half of the market cap of US equities. So you can see they're pretty comparable on kind of a global basis. Like gold isn't something that you would compare to a single stock. It's something you would compare to an entire asset class, because that's what it is. It's an entire asset class to itself. So anyway, like I said, I spent a lot of time trying to construct a market cap time series of gold, which I did. I did. It's an estimate, I will say. It's technically not a precise time series, because like the above ground stock estimate, like I was able to find estimates for each year going back like the last 15 years or so. And then I wanted to have this time series go all the way back to 1970 so I could have that entire time frame. But then from basically past 15 years ago and back, I only was able to get an above ground estimate for every 5 years or so. So what I did is I just had the above ground stock move smoothly between those periods, which is fine in my opinion, because the mine total of gold only changes by 1 to 2 percentage points per year. So there is actually a very low variability in the total ounces amount of the above ground stock of gold on any one year. The variability in the market cap is going to come like almost entirely from the price of gold, which that we have records of. So point is like even though technically speaking my market cap estimate is not a precise estimate, it's probably close to within a couple percentage points at any given year. And I constructed this a monthly series for the record for all. But the point is, I wanted to compare it to a lot of other things. So what I did is I started comparing it to basically a whole bunch of other stuff. I was like, okay, let's compare gold. So like I said, I initially started thinking about this idea because I wanted to compare it to silver. A lot of people I've heard talk about the ratio of gold to silver. So I did do that. I did do the same thing for silver as well. I did compare the market cap of gold to the market cap of silver and looked at the ratio of that over time to see like what has that ratio been like. But I also wanted to compare it to a lot of other things. I compared it to the U.S. M2 money supply. I compared it to the money supply of the major central banks of the global world. Compared it to the U.S. debt level because that itself is an asset class, right? Like the U.S. Treasury is an asset class, and gold is an asset class, and they both compete with each other. Like those are direct competitors to each other. So in my opinion, it's like it makes more sense to compare gold in its market cap sense to the entire debt of the federal government because essentially those two are like actual competitors. So, like I said, I constructed a bunch of different time series to kind of do this. There's a variety of them. Like I said, I have here's I have them all. I actually show like kind of the charts of all of them here all on one page, so you can kind of see exactly how the work all look together. So going through them, I have whenever you see here it says MC, that means market cap, and it specifically means gold market cap. Otherwise, I would all specifically say what I'm talking about. But we have the gold market cap to the US M2, which currently is at a value of 100% or so. That is way above the current percentiles, which let me uncheck the box quick. Second, show it. But I kind of wanted basically you can see like what I did is I created a ton of these pricing measures so that I could look at the median of all these pricing measures to kind of get kind of a on a median basis how overpriced do I think gold is right now. So like I looked at all these values. I looked at what the median upper quartile and lower quartile values were going back to as early as I could for each of these time series. So US the market cap for the US M2, that's basically what this chart shows right here. And the red is the ratio. You can see the highest, most overvalued level gold got to for this time series was back in 1980, 1981. And then we had pretty high overvalued levels in 2011, 2012. And then the third most overvalued level is actually basically right now. And you can see the most undervalued level would have been in the early 2000s right here. Generally speaking, technically speaking, the beginning of the time series is probably not an accurate assessment because even though gold started to free float as a price in 1970, there was probably a few year period where technically it still needed to find that natural price. So technically speaking, 1975 onward might be a more accurate time frame, but nonetheless, we used all the data, but so it might be a little bit more conservative on that front. But point is like yeah, that's how it works. But you can see like we did the same thing for all these. So I did the same. This is US M2, but then here I did the M2 for all of the major central banks of the world. And then here I compared US M2 versus just the gold that the US Treasury owned, not rather than just the entire market cap. We did the market cap of basically US federally owned gold. So it's like basically kind of a similar but lower ratio. So you can see like the shape of the red line is very similar in all of these, but they have kind of different peak points and different trough points. So it's like different ratios. Like one of these, it's like one of these is like a PE ratio. One of these is like a price to sales ratio. One of them is like an EV to EBITDA ratio, right? It's like not really in that sense, but in the sense that's kind of what we're doing here. It's like these are just different pricing ratios, and we wanted to get an idea of like what is the average difference from the median for all these pricing. So like here, market cap versus U.S. federal debt, um, the market cap versus major central banks, sovereign central debt, market cap versus the major central bank sovereign debt, not counting the United States, the U.S. holding of gold versus the Fed assets on the balance sheet, the market cap of gold versus the major central bank assets on their balance sheet, um, market cap of gold versus the global reserve of the United States dollar in all central banks, basically all of the holdings of US dollar ratio, the global FX reserve as a whole, the US holding versus the US FX reserve, market cap versus the US equity market cap. So this is, I kind of did already mention that, is like all the stocks in the United States versus the market cap of gold, all the stocks in the world versus the market cap of gold. The top single market cap stock, I did that as well. I looked at that and said, what was the highest market cap stock in the world in each year, and how did it compare to the market cap of gold in each year? So you can see right here, general. In general, the market cap of gold has been anywhere between 6 to 25 times the market cap of the top stock. Right now, it's 7 times. So it's actually very, very low relative to its average on that particular measure. But that's actually one of the few ones. You'll notice that on the majority of these measures, gold is quite overvalued. Like I said, I came up with, I think it's like 19 or 20 of these different ratios that I looked at, and it's like only like, is that 3 or 4 of them that it's undervalued in. So basically, no matter how you spell it, gold is quite overpriced. And so, yeah, I didn't actually finish them all here. This is equity, uh, U.S. equity, global equity, and then the single largest market cap stock. Then all of these are kind of like more supply and demand based ones, or the real supply of gold versus the population of the world, real U.S. holding of gold versus the U.S. population, the production of gold versus global GDP, the reserves of gold versus the supply of gold versus the production, and then the market cap of gold versus the silver market, like before. So all these different measures, if you look at the median level of overvalued that the gold is across all of them, 60%. Which, if you then were to revert the price based off of that, it means that the implied price of gold would be $2,000 $2019 per ounce based off of that, if it really was 60% overpriced. And that's 60% price from the price as of the end of the year, by the way. So if you did the math on that, you might be like, it's not 2000, it's actually 21 or 2200. It's like, the reason why is because technically it means 60% of the end of 2024 price, because that's really what all of this data leads to. But nonetheless, so yeah, that's the implied pricing if you used all of these measures right here, which, gold is currently at 3,300. So that would be more than a 30%, more than a 33% correction to get us back down to that fair pricing, so to speak, based off of that. So that's nice. That's nice to know. Now, one thing I did say is, one thing I did kind of want to point out is that some of these kind of are very similar to other ones. So you could kind of argue about why you would want to include all these measures. Like, you could maybe like be more selective about which ones you did include, for one reason or another. Some of them don't have the time series go back as far, so maybe you don't want to include those ones as well. So like, I kind of picked and choose with it. I was like, what is potentially like a more generous selection? It's like, is there maybe a way we could be a little bit more generous while also being logical? Like I said, still being kind of logical about which ones we selected, but also being a little bit more generous to it. What could we end up with? I found that in a more optimistic case, I found that it was more like 36% overpriced, which gets us more like 23, 2400 as an implied gold repricing. Which, by the way, if you didn't notice here, I also showed the percentile of the value too here. So like, I think before I had made those selections, it was at like 92nd percentile or something like that of valuation, you could say. And now, based off of that more generous evaluation, you would say it's at the 76th percentile. So there you go. That's my kind of overview of different pricing measures for gold. Like I said, I literally spent like a week working on just this alone. Well, really more than a week, but a week doing it pretty in depth, because I had to do a lot of research to find a lot of the data that went into this. Like I said, like, not only the gold market cap time series, but those like global M2, global central bank balance sheets, debt levels, a lot of that stuff. Like, honestly, I had to do a lot of looking around on the internet to put a lot of this together. But it was very worthwhile, because, like I said, it gave me. I mean, I knew gold was probably overpriced, and like, I had often been telling people, hey, we should probably expect like a 1/3 correction, basically, at any random time. But it was one of those things where it's like, I do like to be able to quantify. So like, yeah, I still basically found the same answer. It's not like I found like a different answer there. It's like, I should still basically expect somewhere between 20 and 40% correction, probably, at some point for gold. But nonetheless, at least I understand the dynamics on which that could potentially face for pricing measure. Now, there's also the actual fundamentals of supply and demand, which we're now going to get into, like I sort of promised a little bit. Now going back over to the here, I had already kind of talked about uh, the supply demand thing, the chart over here, where I'd shown you guys these things on these charts before. But basically, what I did is I kind of went and decided to go, because you can download all this data. Like I said, from this website, you can download all this data. I went and did download all this data and had been going through it over the last 2 weeks or so, and basically trying to kind of create forward projections based off of all of these dynamics here to get an idea of like, okay, well, if that's the supply and demand by year for the last 10 years, what do we think the supply and demand by all these different factors could look like for the next 10 years? And then see like how does that balance out? What kind of impact on prices could that have? So I'm not going to go through every like every little cell of assumption in here, but basically kind of giving you just like a broad overview. Like it gives you a pretty in-depth understanding. Like here's the overall balance, like here's the supply, mine production, recycled gold, and all the other stuff. There's demand, jewelry, technology, investment, central banks, ETFs, and all that, and how it all balances together. And then they do have separate pages where they give you more stuff in even further detail. So like here it shows the jewelry, but you can come over to this page where it shows you the jewelry demand by individual country or regions. So you can even look at that on kind of an individual basis. And the same thing for the bars and coins. Like it shows you the bars and coins here, but also you can look at like, well, what's the bars and coins by different geographic location demand, which two of those together is what they call consumer demand. And then it also gives you the data of like consumer demand by nation per capita. So it's like it gives you a ton of data in this in this series here if you're willing to kind of like go through and look through it. And so that's one thing I did do is I went through, I looked at what was the demand like by the different countries and region for the jewelry and for the bars and coin. And then I looked at it and I kind of made my own estimates. I was like, well, what would I think is a kind of bullish case and a bearish case estimate based off of the last 10 to 15 years of growth? What would I expect the next 10 years to sort of look like? And I'm totally just spitballing estimates here. I'm either basically assuming that there's mean reversion, or potentially that the growth continues, or that the growth gets cut in half. Like I said, I kind of picked and choose a whole bunch of assumptions depending on all these. But nonetheless, I did it all kind of individually, added it all up together, and kind of like saw where it all went for all of these, except for the jewelry, for the bars and coin. And then I did the same thing also for the other categories, cycle gold and the technology, the ETFs and central banks, and kind of put it all together. And I'm not going to get into the finer details of all of it. But for the demand, I mean, I do think that there's pretty strong reason to believe that there's going to be growing demand over the next decade. It's like in my bearish case estimate, I ended up with basically demand 10 years from now at approximately the same level it was in 2024, which the level it was in 2024 was relatively near peak level. Like 2023 was technically slightly higher, I think, than 2024, but those were like the peak years over this time series. So it's like it has been growing demand. And in my opinion, the kind of bearish case for demand 10 years from now is that it hasn't moved anywhere. It's exactly where it was in 2024, which keep in mind, demand doesn't grow very quickly. Like over this entire 10 to 15 year period, it grew approximately 1% compounded per year. So saying it grew -1% is actually technically what I have right here, means you basically just got mean reversion over that time, or not even mean reversion, because that's 1% in total, not even compounded. So it basically means that you just got like 0% versus 1%. And then in my bullish case, I got about 24% in total demand growth, which ends up being more like 2% per year. So my kind of assumption is that demand growth is going to be anywhere between 0 and 2% per year, which the last 10 to 15 years was about 1% per year. So my assumption is that the next 10 to 15 years are going to look like the last 10 to 15 years. Is essentially what that kind of boils out to looking. Now, like I said, it also gives you the mine production numbers up here, which is fine that it does that. And you could kind of do the same thing if you wanted to with the mine production numbers. But one thing that they also do is they also give you another spreadsheet where you can look at the mine production numbers in further depth. Well, so I've done that and done the kind of the same approach with that, where you can look at the mine production numbers by country, by year, and then kind of go into the nitty gritty of it and be like, okay, well, what do you expect from that particular region for mine production for the next 10 years. And this is something where I feel like where making those kind of spitball estimates is actually kind of valuable because I actually do look at a lot of mining companies in a lot of different regions. So I feel like I can look at these percentages and actually make some reasonable estimates about, well, is can they actually produce that much gold? Like, are they really going to be able to grow that much mine production over the next 10 years? And then if some of the regions that have declining gold, I'll know whether or not that makes sense if that's going to continue or not because I've looked at a lot of these more. With the demand numbers, I definitely feel like I was kind of making some somewhat random estimates, like that I didn't necessarily have a whole lot of information to bring to the table on that front that I could really be super certain about. But for the production numbers, I do feel like the estimates I make here are probably pretty reasonable. What I end up with is kind of like a somewhat similar situation where my expected overall increase in mine production is expected to be anywhere between pretty low over the 10-year period to pretty decent over 10-year period. And I see 15% to 38%, and that's in total, not compounded. So on a compounded basis, it would be like 1.5% to maybe 3% per year, which gets you like maybe a little bit higher than 2% per year on average. And coming back over to the demand levels, I put those numbers directly into the balancing year, and that's actually very similar to what we saw for the last 10 years. It was about 2% per year in growth of mine production. Because keep in mind, mine production is only one factor on the total supply. There is also recycled gold, which does make a significant portion of it. So the point is, like, even if you do have a higher level of mine production relative to the growth of demand, that can still be balanced out by the changes in the recycled gold, which would be basically we would just be looking for consistent levels of change that we saw in the last decade compared to the next decade. So long way to say that I've looked at like all the individual line items of production and supply for gold at a pretty in-depth level, and I feel pretty confident that and the worst case scenario, supply and demand is pretty well balanced over the next decade. In the best case scenario, there is going to be higher levels of gold demand both on the central bank level and on the consumer level that I haven't really accounted for necessarily in some assumptions. So long way to say that I do feel pretty good about the supply and demand balance for gold. Now, coming back over to that discussion about the those pricing measures, that doesn't take into account the fact that basically what I was saying before is that we are already overpriced. So look at this. Like if I was to compare this to a stock, what I'm saying is that I like the fundamentals. I like the company. I think they have good growth prospects over the next decade, but they are overvalued, right? Like that's the situation I'm sort of in with gold. But nonetheless, I feel pretty good having done a lot of this work because prior to doing this work, my previous gold targets that I used in my valuations were based off of a regression on the money supply, which I still feel pretty good about those because the statistics surrounding those are pretty good. And it had given me I had created kind of like a set of gold targets for the next decade or so based off of that. I also used a relative basis of money supply and central banks a little bit as well in this. But basically, I had already created a range for gold prices between 10 years from now, from between 2,900 or so to like 64, 6,500 or so, with a base case being like 4,200. And so basically, I kind of compared the two a little bit. I was like, well, what would happen if in the long run we did head towards these targets right here, but in the short run, we actually had a strong price reversal because of how overvalued, overpriced we are, so to speak. And then my goal is to kind of readjust my valuations based on that. So I kind of created a set of gold price targets kind of over here that kind of has those assumptions where I assume like a base case that this year at any kind of random point gold could correct to maybe about 26 2700, and then over time over the next decade we would move up towards about maybe 4700. And that kind of internally within that assumption we're assuming that we revert significantly on this overpriced level, but not all the way back to it necessarily, just a lot backward on it, and then we probably continue to grow from there. So, like I said, I basically created some new uh, goal targets I'm going to use for my valuations. I only kind of finished this process literally like yesterday, so I haven't actually updated the valuations for my gold miners yet with those assumptions yet, but I had already updated those assumptions previously a little bit recently. And I think the new assumptions it's kind of tricky to say because I think the 10 years from now goal assumption is now probably a little bit more bullish, but I'm also, like I said, going to be using a lower short-term gold price, and I think my previous valuations had assumed the current gold price. So I will probably be more, I'll essentially be more bearish on the short-term cash flows, but I'll be more bullish on the long-term cash flows with that revising of my valuation. So a long way to say that I'm not actually sure how that's going to change the valuations. It's possible that they don't really move that much. That the where my current valuations for my gold miners is could still be basically about where they are. Which for what that is that for Silver Corp I find there to be a pretty significant amount of upside. For Equinox I find there to be a pretty significant amount of upside, and then New Gold and Orla I find both to be roughly around fair value. New Gold I find to be a little bit overvalued, but roughly so, so yeah, that's where I'm at with that. I did kind of already input the new assumption about my gold price into my gold ETF here, which sounds to be about new fairly valued. But like I said, I'm kind of just watching the moving averages with gold to kind of see what's up with that. It's like if moving averages start to kind of tilt downward, or we get like a death cross or something like that on gold or something like that, that'll probably be the point where I will trim my gold trust holdings pretty significantly. But until then, we're just gonna ride the momentum on the gold trust stuff. But I needed those gold targets at least to try to think about what do I expect for my cash flows for the gold miner. So that is going to be the work I'm uh, here in the here in the next week or so. So that's it surrounding gold. But I also, because like I said, I had also worked to construct the market cap series for silver. So I what I did is I also did went and did basically the same approach for silver as well, using kind of similar data. Technically, silver does it a little bit differently, and you have to go to a different website to get the data for silver. It's not on the gold.org website, but I did kind of put it in the same Excel spreadsheet because it made it easy for me to track. But basically, I did kind of the same work in regards to the expected mine production by region for silver, as well as the different demand line items for silver. And since I do have that significant investment in Silver Corp, which is currently more focused on silver than gold, even though that is the plan is for that to change over time, hasn't yet changed. So when I did do the kind of same work for silver, which I find kind of similar results, I find that in the worst case scenario, the demand supply balance is relatively balanced and maybe a little bit more tilted towards supply than demand. But under certain circumstances, and kind of under at least a base case assumption, I would expect there to be more growth in demand than there is growth in supply for silver for the next decade. And I would say that for the silver story, it was a little bit trickier to project out some of the assumptions for the demand line items because for gold, um, outside of the investment categories like the ETFs and the central banks for gold, that stuff has been growing a lot in the last few decades. So it's you do have to kind of make some strong assumptions about where those are going to go. But the industrial demand for gold is relatively stable. Whereas for silver, the industrial demand for silver is not that stable because there has been a significant pullback in certain types of usage of industrial usage of silver because of price changes. But then there's also been massive growth in other categories of industrial usage of silver, specifically the photovoltaic category, which is like going into solar cells for for solar power. So silver has absolutely taken off in usage for that category. See, it literally went from zero usage in that category in 2010 to over 232, I believe this is in million ounces of silver for 2024. And you can see like that doubled from 2022 to 2024, and it doubled from 2015 to 2022. So that was like a 6 to 7 year period to double, and then a 2 year period to double following that, right? Like so, you can see that the growth is accelerating. The growth in photovoltaic usage of silver is massively accelerating in the last few years, and so making a projection for where that's going to end up 10 years from now, I will admit, is very tricky. And I think that my choice here was very conservative. Actually, I chose to assume a huge amount of mean reversion in the worst case scenario and to assume a relatively moderate amount of growth in the bullish case scenario. When in reality, it's probably more reasonable to assume a moderate amount of growth in the bearish case scenario and a more high level of growth in the bullish case scenario. So like I said, while I kind of currently assume similar levels of supply demand balance imbalance potential for gold and silver, there's technically some potential for silver to have a really high level of demand depending on what happens uh, with solar power. But also, I will say, with that in mind, there's also other ways in which the supply could also come online a lot higher with silver too. It's like silver mine production has been coming online a lot slower than gold production has, but the overall total supplies of silver that exists out there and the reserves of silver that exists out there are much higher. In fact, that's basically one of the reasons why the price of gold is so much higher than silver in the first place, because frankly, silver is just way more available. Gold is much more scarce. And so, even though, yes, technically there is some potential for silver demand to spike pretty dramatically over the next decade, there's also potential for supply to meet that under certain circumstances. So, I don't really want to count on that photovoltaic uh, category bullishness too much. So long way to say that I feel pretty good about my positions with my gold and silver miners. Like I said, I do want to adjust the cash flow assumptions a little bit for my miners based off of those assumptions, but I don't actually think it'll change my valuations too much because I'll be kind of shifting the timing of those cash flows a little bit too, not just the levels of it. So it may not actually change the valuations too much, but I'm going to do that anyway, or probably over the next week. And then, like I said, I kind of already have my plan in place for gold, which is that I'm watching certain indicators, certain moving averages to kind of indicate when I think momentum has maybe fallen apart for gold. But in the meantime, yeah, we're just gonna ride the wave gold and see what happens with that. Because while I do think it's overpriced, that does not mean that it has to come back down anytime soon. The consistent trend in all of these time series, if you'll notice, was that 1980 was a pretty wild time. I didn't go back to see what the averages were going into the 1980s for this, so I can't tell you how quote unquote overpriced it was in 1981 or whatever. But like it's pretty obvious that that was the quote unquote most overpriced point gold ever reached, at least based on this data. And so the question is like, even if it seems like we're overpriced here, I don't think we're necessarily that overpriced yet. So even though, yeah, this says that it should maybe go down to 2,400, that doesn't mean that we don't go to 5,000, 6,000 first and then go to 2,400, which would be pretty crazy if gold decided to act like Bitcoin a little bit for a couple of years. I think it'd be pretty funny because what would the Bitcoiners think under that circumstance? But anyway, so I think that's pretty much it for here to do today. We talked about pretty much everything I wanted to talk about. Talked about all the earnings for my companies. Talked about on data. Talked about gold and gold miners a little bit. My strategy surrounding that. As I kind of predicted, we didn't have a whole lot of viewers show up. Just Scott came to keep me a little bit company, which was nice. But like I said, that was kind of convenient because I did have a lot of stuff I wanted to talk about. So in some ways, that's somewhat convenient because it means that I get less distracted and kind of keep the train rolling. But of course, I still always love my viewers. I'm always happy to be derailed on my live streams. That's never a bad thing. But nonetheless, best laid plans of mice and men and all that. So anyway, that's gonna be it for today. Like I said, I kind of have pre-planned days off on Mondays throughout the year. So my plan was to always kind of try to use those for streaming. So hopefully we'll be kind of having a mid market hours kind of stream going forward. Though obviously we kind of did towards the tail end of the day, and we didn't really talk about today's market necessarily. We're not day traders, so that doesn't really matter too much to us. But it was a down day. Interesting to see on that front. I did kind of give my comments that I think that this could be a little bit of a bounce. I don't want to call it a dead cat bounce because I don't necessarily think that we're for sure going to go to lower levels. I think we certainly could go to lower levels, but like it wouldn't surprise me if it's like it wouldn't surprise me if we did continue to chug up from here. But my base case assumption is more like that we come down at least to sort of retest and then maybe come back up from there. Like that's kind of like my base case assumption is that we create like a W here for like most of the rest of the year. It might be a wide W. Like maybe we're down through the rest of the summer and kind of come up through the rest of the year. That's probably like my base case assumption. But if we just kind of chugged up from here, that wouldn't really surprise me that much. Nor would it really surprise me if we just continue to go down from here. It just that would entirely be based on economic data, right? And I mean, obviously, my regression channel that I have on right here certainly seems to believe that that's the direction we're going. But regression channel with a 77% R squared. But you know, there's other regression channels to make different arguments for. So take that for what it's worth. But whatever. So you know, enough horoscoping on the market for today. We're focused on our individual companies. But anyway, like I said, I'm going to make those adjustments on my gold miners, but I'm also looking to for the next few weeks try to divert my attention from my portfolio companies and start to try to look at other companies again. I really have been just not looking at other companies hardly at all. I know lots of my viewers, lots of the server members have sent me tons of tickers over the last couple of months that I basically just have like largely ignored because I've just been kind of doing my own thing, focusing on my industry and stuff. But I do feel pretty kind of settled a lot of that now. There's like not really much more to do other than just monitor a lot of stuff. So I am going to start trying to do a lot more screening for stocks here in the near future. I'm still trying to be very concentrated. So if I do take positions on some smaller, very cheap companies that are lower quality, they'll probably be very small positions and not really adding to them much. Kind of my plan, like little like half% positions, 1% positions. I add a few of or something if I find some really cheap ones to hold kind of short midterm a little bit. We might look for some of those, but nonetheless, other than that, we're just kind of looking for dips on our favorite companies, which maybe we'll get on our W, maybe we won't. I don't know. Maybe we will if FG plunges on earnings here this week, or maybe not. I'm hoping for that, obviously, see for good earnings, but assume the worst, plan for the best, right? See see what happens with FG here in 2 days' time. So that's gonna be it for today. Thanks for Scott keeping me company, and thanks for anybody that watches this on the replay. Obviously, like the stream if you like the work I do. Subscribe to the channel if you haven't already. I'll catch you all in a week or two or whenever I happen to stream next. All right.